Welcome to TheoTrade. This is Don Kaufman. August 1st, 2020. Doing the weekend update here on a Saturday morning with market divergences just growing at alarming levels. We'll come to the obvious here in just a moment, and that is, of course, discussion of some of the tech earnings. But before I get there, we're going to take a glance over, of course, the S&P 500, which is right now towards the upper end of a recent range. Big question right now. This about to be the big breakout, the breakdown. I don't think it makes a difference. I think we're going to look at some backspreads. In fact, on this weekend's update, I'm going to look at a lot of very specific trades and trade opportunities that are coming right now to you. So with a start on this weekend's update here, we're going to just glance at the S&P 500. Which is, of course, I mean, we're only a hop, skip, and a jump away from all-time highs. You know, another way to actually look at this, if I bring up the spiders and you take a look at the year-to-date basis, a lot of people don't necessarily do this on a day-to-day basis, but I actually do. I like to see where's the spider on the year. Wow, you know, with everything that we've gone through in 2020, if you had told me the S&Ps were going to be massively unchanged in the year, I probably would not have believed you. Of course, if you take a look at the QQQ, all right, just of course the NASDAQ, it's up 23%. And then last but not least, we will look at the IWM, the Russell, which is actually down 11%. Now, don't worry, we're going to come back to that a little bit later here, the discussion of the divergence, but I just wanted to kind of kick it off with it. What is first and foremost kind of on my mind on this weekend's update and what we're going to be facing literally early next week is the range. And when I'm talking about the range, all right, so we've established kind of this new range. In fact, I think the better way to look at this, I like to look at this like on the S&P futures, a 30-day 1 hour, because the point, and I've made this point a lot lately, most of the trade that we've seen, you know, people were just shocked what happened on Friday, and Apple's news was unbelievable, and Facebook, I mean, Facebook, okay, you got me on Facebook, all right? That one hurt a little bit. But when we take a look at the range in the S&Ps, okay, same story, different day. We haven't actually cracked to the upside. We're just towards the upper end of the range. We saw this upper end of the range, you know, a little over a week ago. We were there a week before that, yada, 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 and we're there again. The point that I'm making with this is we haven't cracked necessarily the upper end of that range. You know, the same is also true, and this is where I also wanted to bring the NASDAQ into the discussion, the NASDAQ. And with the NASDAQ, look at this. All right, we're still more than a hop, skip, and a jump away from the all-time high, which was actually hit back in kind of early to mid-July. Nevertheless, you kind of get the idea here where I'm going with this. Yeah, we're completely boxed in. We're in a type of a volatility box once again, and we've seen this type of trade really consistently and persistently for quite some time. What I'm actually referencing with like volatility boxes, I'll open up a bit more in terms of a time frame here. Right back here, really definitive. I mean, that's a volatility box where we're just, when I say a volatility box, we just ping back and forth, and it's market making firms like unloading gamma risk. They're using the futures contract to hedge, and we just get wound up in a tight range. And what do? Okay, lo and behold, we literally pop, okay, to a new range. I actually think this, okay, when I say this, all the way from this 3,000 level to effectively where we are now, I just think this is actually part of one larger volatility box at this point. And it's actually why I wanted to spend a little bit of time in the S&Ps here. This is not an extraordinary range. It might look like a lot. I mean, there's a lot of time in here. You're going all the way back to what? Oh, kind of mid-May when we came into here. And here we are right now. But for the most part, what do you got? From 3,000 to 32, you know, we'll call it 70. So all we're doing is basically oscillating back and forth inside of a kind of a volatility channel, but we are towards the upper edge of that. So why do I bring that into scope? Because there's some interesting trade opportunities. Now, at this point, I don't care whether you've got bullish positions on, bearish positions on. All I want you to get to kind of recognize on this front is that I'm gonna look for backspreads here because the skew is going to be favorable. And I'm going to look for backspreads because I'm inclined to believe, and I'll just kind of script this out for you. I'm inclined to believe that if we do actually break the upper edge over here, you know, we're going to get wicked, right? We're just going to pop pop to the upside. But that is not set in stone. I mean, again, you come to the upper edge, and we've done this before, and we actually cratered from there. Nevertheless, I think a backspread is the best way to trade this. And what's my backspread going to look like? And again, this is a bullish backspread. And I'm, again, most inclined to use a backspread. We'll go a little further out in time here. Open up a few more strikes. One of the reasons I like the backspread, if you take a look at the implied volatility out there, the implied volatility is going to be very much in your favor. But point being here, if we're to build a backspread, here, this one's for like a whopping 14-cent credit. We're going to come over here. We're gonna analyze the trade. We'll come over here, risk profile, drop that in my risk profile, hide all my positions, and what do you got? Well, first of all, you have a Don with a lot of caffeine in him, but here is the pop to the upside. If that pop is going to happen to the upside, I need to be ready for it. And I know everybody looks at these risk graphs like worst case scenario. We'll never get to worst case scenario, but if let's just say you do, you need us north of 340. Again, you need us north of 340. And that's more than a hop, skip, and a jump away. I mean, then 340 in the spiders, you're hitting what? Effectively all-time highs in the marketplace. But hey, be prepared. But the point that I want to make with this, the trade right here, okay, is to the upside, except it's done for a 14-cent credit. So if we absolutely tank in the marketplace, we're still going to get to keep the 14 cents. I mean, the bottom line with it, again, you just can't go wrong. I mean, listen, it doesn't matter. Breakout, breakdown, no matter. It's a backspread. And that's exactly why we look at trade opportunities like this. Listen, I've got some bearish positions on. If we break to the upside, and again, a break to the upside, that's more than, as I said, a hop, skip, and a jump. You'll be hitting into all-time highs. And if we hit into all-time highs, okay, I'll be ready for it. And listen, when it comes to this, there's not going to be any in between. If we start exploding to the upside, we're going to do just that. At this point, I think you're a coin flip, and that's why I'm using this particular backspread. I know all the technicals in the world over here are not going to get you and cut through what's going on inside of markets right now, and everybody looks a little bit perplexed, and you should be. I mean, and we'll talk about this in a moment, a whole lot of bad news with a marketplace that is being forced higher. So, which brings me to the point, 5 firms in the fate of the markets. I was talking about this, throughout the course of last week. But when I say 5 firms in fate of the markets, here, this is the analysis. And I've brought this up a couple of times. All right. With what just occurred, all right, this past week with earnings, everybody came out and everybody heard they added almost, $300 billion more in market cap. Listen, the top 6 companies, and don't mistake me here, I'm saying the top 6 companies because Google is technically 2 of those companies, because Google's got, we got A shares and B shares and C shares. Anyway, Google counts for 2. So for the most part, the top 5 companies, the weighting is now 22% of the S&P 500. And that should intimidate anybody. Okay. I mean, what you basically have is the top 5 companies, which this is, the top 5 companies, are worth more than, in the S&P 500, literally, they're worth more than what? Oh, the next, 20 companies all it just goes on and on. I mean, so many statistics in here, all right? But when you start looking at this, it is, it's not awe-inspiring. I don't look at it that way at all. I look at this as, we're going to look at a comparison chart here in just a moment, because the divergence is so large. But the one point that I want to make, and I want this to be heard before I actually show you some of the comparison chart. Listen, the divergence in the marketplace, it has become tech versus the world. And, and I'm going to say here in a moment, earnings, they've been great, unless, of course, you're living in the real world, which is the non-tech world, right? Because we're going to look at specific sectors, and it's going to be hideous out there. But the point that I want to make with this is a very simple one. When in market history, your own portfolio or otherwise, has concentrated risk ever been a good thing? And think about that for a second, all right? If you're thinking about your own portfolio and, you owned a lot of one stock, and some people are like, I've made a great fortune in one stock. Yeah, but most, generally speaking, when there's concentrated equity risk, find that has not, ever been a good thing. The problem with this is I'm taking from like a portfolio. Like everybody knows, like, yeah, you know what? You should probably spread some risk out. If you have a couple of $1 million, you should go out there and you should sprinkle a little here, maybe mix it up with some bonds, get kind of. The S&P 500 doesn't have that anymore. The S&P 500 is concentrated risk. The entire S&P 500 is concentrated risk. People, that was the point of me bringing this up. When you have 20%, okay, of everything, if you're in the S&P 500, if you own a 401k, it doesn't matter. 22% is tied up ultimately in 5 different products out there. And again, concentrated risk has never been a good thing, and I've been talking about the death of diversification. With that, though, I'm also going to bring up another chart. This is a comparison chart, and what you're looking at here, specifically in the comparison chart, and I kind of just take you through it. The divergences, and this is a year-to-date basis. So let's get down to business here. This is year-to-date basis versus the S&P 500. I know it looks like spaghetti over here, but that's the XLK on the very top, the very bottom, none other than the energy sector. But the point that I want to make over here is I've been looking at these comparison charts for decades. The top performer over there, okay, year to date, you're up about 18%. The worst performer is down 40%. The divergence between them is nothing less than staggering. That is just one very, very simplistic way to look at it. And again, I could take this into like infinite depth. And I think that everybody recognizes that there's trades unto themselves. By the way, the second worst performer is the financials, which we're going to talk about. The utilities are not performing well right now. What's kind of in the middle over here? XLY, which is ironic but XLY is heavily, all right, there's consumer staples and consumer discretionary. XLY is actually consumer discretionary, but the XLY is pretty much it's all Amazon. So it's a little bit distorted in this particular case, and all of these are actually ETFs. But I think another way to kind of look at this, and I'm actually going to bring up the QQQ, and I'm going to drop my style down over here, and we're going to look at a QQQ SPY IWM. And again, this is the one that really kind of speaks volumes to me, is that the divergence, and again, this is just on a year-to-date basis. You're 23% in the NASDAQ, okay? You're down 11% in the IWM, and the S&Ps are caught right in the middle. That divergence, nobody's ever seen anything like this before, in really any marketplace. And that's why, again, we go right back to this idea of this concentrated, equity risk. I'll show you something even kind of crazier here. That's a year-to-date, but look at like 1 month, okay, to show you how wild the divergences are in short periods of time. Again, this is just a 1 month. And whenever you use a comparison chart, okay, the first point on there, all right, it always starts from a common origin. But I wanted to show you how steep the divergence is literally in like the last couple of days, where the NASDAQ is up 6%. And yet, again, the other marketplace, which is right there, the IWM, is only up about 4%. A divergence of about 2% inside of like a day or two is, again, they're beyond alarming numbers in here. And if you open this up over, that's a year, again, comparison charts are all what you make of them. And that is the longer time frame, the larger the divergence you're going to see. Here's another one over the last 3 years where the NASDAQ is effectively up 85%. The Russell is generally speaking flat, and the S&Ps are up some 32%. It's some shocking numbers when you start to put that in perspective. And again, that's all I wanted to do real quick, is put that in perspective. Because again, you have five firms that are literally driving the entire NASDAQ 100 here. But it's the S&P 500 that is the danger. Now, with that, earnings are great. Earnings were great on Thursday. And I think everybody was a little bit taken back, not only by Apple's numbers, absolutely phenomenal. Okay, there's no question about it. Facebook, okay, this one hurt a little bit. I've kind of carried a position in Facebook for a while. This is, for me, the most surprising. And I'll tell you why it's most surprising to actually see Facebook to the upside, because we heard everything about the boycott, because, we heard everything about, Coke pulling advertising as one of the number one in here. I can go all day about Facebook, but we have to remember those numbers, again, generally speaking, are backward looking. We have some limited guidance to the future over here. And Google, interestingly enough, didn't necessarily perform well, but bid up a little bit. But neither here nor there. Like, I look at the earnings, kind of take it with a grain of salt. The point, though, that I wanted to make is the divergence. Okay, you have to start to look at real products. And when I say real products, Like here's an entire sector. This is the energy sector. Chevron came out late in the week. Absolutely horrific earnings. When you start to look at Chevron, and here I'll just look at the XLE and the year-to-date basis, it's down some 40%. When you start to look at the XLF, these are the financials, they're down some 22%. The Russell, and I just wanted to bring the Russell into scope here really quick. The Russell itself is actually down 11%. The alarming part was that the Russell actually took a pretty good hit. Again, the Russell took a pretty good hit on the day yesterday when the rest of the marketplace diverged a little higher. Yeah, the Russell followed suit, but again, it's everywhere that you want to look. Everywhere that you want to look, okay, the performers are nothing more than tech, and you'll have an extraordinarily difficult time finding any performers that are outside of tech, other than maybe a couple of healthcare biotech stocks. Like everybody's going to point those out on me, but that's fine. All right. I wanted to throw specifically like Caterpillar in here because Caterpillar has always been kind of a staple in the entire economy. So if you look at something like Caterpillar, it's been a great, as I said, kind of a staple for the economy. If you want a litmus test for the broader economy, Caterpillar's actually been rather good at kind of handicapping that. It too is down about 11%. It's interesting to find that Caterpillar is tracking the Russell pretty close on a year-to-date basis. I found that interesting. So I'm going to move past that. So we already talked about one trade, which is of course the backspread, the 5 firms, and the fate of the marketplace. The next thing I wanted to bring up over here, of course, is going to be the metals again. The only reason I'm bringing the metals back up is, I asked a question last week, and that question still remains. Gold, bonds. The big question over here is this. Is gold and bonds, and gold, of course, hitting the 2000 level, and bonds also rallying up. And again, bonds are breaking out, if you will, to the upside of what has been an incredibly tight trade since the Fed basically gripped hold. Is this a rally or is it defensive posturing? And we still don't have an answer for that. I keep looking at this and thinking it's the rally of everything. But one of the things that I can't get away from is that you talk about like risk on and risk off asset classes. And when we say risk on, risk off, right? The bonds, when they rally, people think of them as defensive. When gold rallies, typically, people think of it as being a little bit defensive, and all your metals are rallying and all the bond products are rallying right now. Listen, this could just be, we're just flush with cash. Okay. I'm still looking at this. And when you look at like the ZN, these are the notes right now. These things have been ripping the last 4 days. I'm sorry. Experience tells me I don't feel warm and fuzzy, okay, when the bonds, and I do want to show you this, when the bonds are ripping, okay, and let's just close that up for a second. When the bonds are ripping, there's not a roll in play right now. I just wanted to show you that. The bonds are ripping to the upside, and they're doing it on considerably higher volume. So, again, I don't feel warm and fuzzy, and I think that the financials, they already feel it. But right now, technology has been rather impervious. Okay, it's just been impervious. Nevertheless, though, Friday's trading session was anything but certain. Let's all be clear. Friday's trading session, we came down and pretty much touched into the 32.11 gravity point and then ripped at the end of the day. There was a bid under the marketplace at the end of the day, but net, things, were not necessarily happy on Friday's trading session. However, was masked in very large part by the fact that 5 firms, are driving a lot of the S&Ps. Another thing I wanted to display over here. So, by the way, the gold, the bonds, the rally of everything, or defensive posturing, I still believe this is defensive posturing. Okay. Whereas, everybody's looking at the marketplace on the professional side and going, I'll just mark my time and wait for this to happen. And when I say this, I mean, hey, listen, sooner or later, okay, the real numbers of the economy are going to catch up. All right. A couple things that are definitive here. We're in a recession. It's definitive. That right now, right? You ever seen a marketplace like this that's, again, in a recession? Okay. Well, you're like, no, I haven't really seen that before. Well, that makes sense because you have all the retail clients driving the order flow. It's exactly what I talked about last weekend, right? So you have retail clients driving order flow. Everybody's sitting at home with their checks and so forth. I think this is going to be slow to unfold. And we are in very, very serious territory in terms of the real economy and the marketplace. Okay. Is it detached? Absolutely not. Again, people keep talking about the detachment. Maybe if they're in fundamentals right now, it's detached. Okay. But the marketplace is rather efficient. If people are willing to put capital forth and put risk on the table, look no further than what the S&Ps are doing right here, right now. Now, that doesn't necessarily influence, my forward look. Okay, so I know a lot of retail clients are in there. A lot of retail clients are actually driving the trade and driving it higher in here. But from 15 years in the brokerage world and everything I know about retail clients, all right, the first time we actually get some serious sell-side activity, people are going to be running for the hills and try to bid into it and buy it up. Okay, listen, the market as a whole goes as far out of its way as possible to screw each and every one of you individually. You be really careful with this. When the marketplace goes up and you don't try to buy the dip, and sooner or later the dip is going to buy you. The next thing I want to talk about is retail. I actually see some pretty huge opportunities. I like the risk reward in terms of retail and the short side of it, whatever that does for you. Retail right now is completely flat on the year. And again, let's talk about this. This is really, when I say retail, it's consumer staples. Consumer staples right now is effectively flat on the year. I have a number of bearish positions on here. This last run to the upside, that just did it for me. Again, it's flat on the year. It's right in line with where the S&Ps are. But from a sector standpoint, I think there's really viable risk reward to the downside in here. Next on the docket here, we're going to look at a couple of VIX trades. VIX, the reason I wanted to discuss the VIX, I am a big proponent at this point in time of outlier type trades. Okay, those outlier type trades, as long as the VIX is going to be down this next week, if the VIX is going to be down, you're going to see me do, again, a bunch more. When I say outlier type trades, I'm actually selling put spreads. I'm selling put spreads to turn around and finance, okay, just way, way out of the money call spreads. I mean, like crazy stuff. I want outlier trades on right now. Do I see anything like, imminent? Is the marketplace going to absolutely tank? Is it imminent? No. Okay, that's not the reasoning here. But the outlier type trades, the skew is so favorable. Like, why wouldn't I want to do this? And I'm just showing you a couple of outlier type trades in here where, and I'm playing around with the strikes as we go, where we are capable of selling a $5 wide put spread, which is closer to the money, to buy, $20, $25 wide call spreads. And if the marketplace, I'm not saying we're going to make $25 on this, but if the marketplace is to tank, okay, this VIX spread is going to be a wonderful hedge for us. And I'm looking for a couple of those outlier type trades on there. And I'm October. Don't go as far as November. Listen, the election's already priced in to this thing, and you can actually see it in the pricing and see it in the skew. Nevertheless, I'm not too concerned about it, but I am going to continue to bid into these types of trades because, quite frankly, there's just, the risk in there of the VIX. Was the VIX going to collapse below 20? Maybe. Okay, but if it does, so be it. I'll still go after the outlier type trades. Last, but definitely not least in this weekend's update here, SPX. The SPX, okay, third week in a row. And this one's really starting to get a little perplexing too. For the most part, you got 1, you got 2, you got 3, okay, you got 4. Now, when I was saying third week in a row, it's the third week in a row that we haven't even gotten close. This week I'm actually counting it got close this week, but it's I say no touching for 3 weeks. It was close again yesterday that we actually almost touched the upside of the expected move over here, but for the most part, okay, we are entering into again some unprecedented times, and the expected move not only hasn't been breached in the last couple of weeks, but only yesterday did we even really get close to the upper edge of the expected move. And this one really resonates with me. And the reason it resonates with me is we are seeing, and I could go on for hours about the expected move kind of not being tagged. Listen, we're still sitting in a neighborhood of a relatively high VIX, right? So we've got quite a bit of volatility, but the marketplace, all right, as it is actually driven higher, and this is one of the more important premises here, as the marketplace is actually driven higher, the volatility isn't really going down. And I know everybody, again, as I was saying a moment ago, was, you look at the VIX and you're like, but the VIX is doing this and the VIX is doing that. The point that I want to quickly make over here, but the volatility isn't really going down. The volatility kind of found a floor here at this 24 level. And we're about to approach the third week at these particular volatility levels. But the other point to be made, these expected moves are literally on a week-to-week basis. And the expected move has been similar. I mean, last week it was like $74 expected move. And again, we got close, but we didn't necessarily tag it. We did not tag the edge of the expected move, and we've had some rather close calls. And this one is one of the more perplexing things because as the market's grinding higher, they're not crushing down the expected move. They're keeping the expected move relatively high, so volatility becomes constant. This is a time where you have got to, again, be incredibly careful. It's one of the reasons that I talked about that backspread to begin with, because if we explode higher, we're going to rip through here. I don't believe that someone can time, okay, an outlier type move. All I can believe is that you could be ready for it. I have multiple outlier moves. I'm going to have an outlier move trade to the upside, which is going to be the backspread. I'm going to have the VIX trades, which you saw I have on, okay, for a quick move to the downside. That is the way that I'm trading this right now. There's plenty of stuff that I'm doing, okay, on a day-to-day basis, like for these inside moves. But net, I'm still looking for some big outliers because what is unquestionable and perplexing at this point, the number of breaches we've had of expected move, and all of a sudden it just completely abates. And I say, again, 3 weeks without like a breach, but it's 3 weeks without even really touching. Yesterday, again, I'm given the fact that the marketplace rallied up yesterday, again, it rallied even a little bit more after the market closed. Technically, we're right to the upper edge of that particular expected move, but we ain't home yet. This, again, it's disconcerting. It's disconcerting simply because all of these breaches over here, all we're doing at this point, I believe, is marking time. And that's what I wanted to kind of highlight over here. I believe we're marking time inside of a very tight volatility channel, and we're ready to erupt through it. Again, this many weeks without actually touching one side or the other over here is alarming unto itself. But the bigger and broader concept that we need to kind of grip hold of here, right? I don't necessarily think an Apple or a Facebook or a Google is going to tank tomorrow, but as the divergence has grown, okay, you have to be alarmed about the entire structure of the S&P 500. And frankly, when you look at this, everybody should be alarmed, okay? The entire wealth, all right, of the marketplace, and for the most part, 401ks and IRAs of the United States rests right now in the hands of literally 5 companies. You already know, in this case, you're like, nah, it'll be okay, but you already know that the financials, which were one of the largest sectors, are down 23%. The energy complex over here, the energy complex now pales in comparison to the size of anything. It's down 40%. Those are 2 huge sectors, okay? The only thing holding us together right now is legitimately, a Microsoft, a Facebook, okay, a Google, which is only up about 8%. And this is not warm and fuzzy stuff, because life savings depend right now on 5 companies. But what you're going to find is if we start to break down, specifically if you saw Google started to fall, it is going to pull, okay, the entire S&P 500 down. It will not take 5 stocks coming off to cause sell-side activity. All you're going to need is 1 or 2 of them to actually spark correlation, to actually see those market divergences, instead of growing, collapsing upon one another. But again, we are in some really serious times right now where retail trade is driving capital and driving 5 underlyings to pretty much run the roost of this marketplace. Thanks everybody for joining us here at TheoTrade and the Weekend Update. Have a wonderful weekend. Bye-bye.